One of the most important concepts when it comes to investing in the stock market is risk level. Investing risk level is literally the level of risk that you take on inside of your investment portfolio. And in general, higher risk investments have the potential for a higher reward, but also the potential for larger losses. And it's vice versa for lower risk investments too. Now, there's two main components of risk level: risk tolerance and risk capacity. Risk tolerance is the emotional side of the equation. It's all about how comfortable you are with the idea of losing money over the short term in order to gain a higher return over the long term. Risk capacity is the factual side of the equation. It's all about how much risk you can actually responsibly take on without negatively impacting your long-term financial stability. Basically, risk tolerance is how much risk you think you can handle, and risk capacity is how much risk you actually can and should handle. Now, something that's really important to highlight is that in the traditional investing industry, risk level is typically very heavily impacted by risk tolerance. When you walk into a bank or any traditional financial institution in order to start investing, the first step that they'll usually have you take is filling out something that they call a risk questionnaire. Now, a risk questionnaire is basically a series of questions that's meant to figure out so the investor's risk tolerance specifically. It'll include questions about your financial situation, like how much money do you make, how stable is your income, how much money do you plan to invest, how long do you plan to invest that money for, like is it for a retirement or to buy a house. Also about your investing confidence, so how experienced you'd personally consider yourself to be, and a big part of it is situational questions to see how you'd react as an investor if your money went up or down in value. For example, they'll ask you things like, over a certain period of time, if your investments went down by 4%, what would you do? Sell everything, sell some, do nothing, or buy more. And we can actually take you through an example here so you can see what it would look like. This is actually Vanguard's current investor questionnaire and some of the questions that they ask you throughout it. Now, the goal here is basically to figure out how comfortable and confident you are. And the idea behind this is technically good. They want to make sure that you're not going to panic sell your investments over the short term if the markets happen to be down at a certain point in time, which again, at points it will be. But the main problem here is that it really puts risk capacity aside. So in this video, we want to break this down more and also really highlight how your investment portfolio should ideally be based on your risk capacity and not your risk tolerance, and how filling the knowledge gap between the two is really key. So let's get into it.
Okay, I want to back up for a second and highlight that when it comes to investing in general, but we'll stick to investing in the stock market specifically here, there is always some risk involved. When you invest in a stock, an ETF, or any other stock market investment, you're doing that with the intention that the product goes in value so that you make money. But on the flip side of that is that the product could also potentially go down in value and you could lose money. But all stock market investment products aren't created equal. Different products have different levels of risks associated with them. In general, low risk products mean that in the best case scenario, your return potential would still be low, and in the worst case scenario, your loss potential would also be low. On the other hand, moderate risk products mean that your return or loss potential would both be moderate, and high risk products mean that both your return or loss potential would both be high. Now, the way that we figure out what the level of risk that each investment option has is based on the potential volatility of each investment option. And by the way, volatility basically just means the size of the change in an investment's value. So literally how high the highs are and how low the lows are. So high risk equals high volatility. So that means that the potential for the investment to go up or down is high, aka it covers a higher range of values. And same thing for moderate and low risk investments. Now let's give you some examples of what we mean when we talk about high, low, or moderate risk investment options. Higher risk investment options include things like cryptocurrency because it's newer and a highly speculative investment option. Also, options trading, day trading, investing in penny stocks, and speculating on single stocks in general. Low risk investment options include things like government bonds because they offer stability, guaranteed investment certificates or GICs, as the principal is actually guaranteed, and more conservative funds that include fixed income investment options. Moderate risk investment options include things like all equity funds, which are funds made up of 100% stocks, because funds offer diversification. You aren't putting all your eggs in one basket like with single stocks, but with an all equity fund, you're investing solely in equities, which are stocks, and stocks have a higher volatility than bonds, for example. Now keep in mind that funds in general have varying degrees of volatility and therefore risk. Now this is because funds can have any mix of investment options inside of them. Like how a fund made up of 100% bonds would be lower risk than one made up of 50-50 bonds and stocks, or one that's made up of 100% stocks, for example.
Now, when it comes to choosing the right investment option for you, risk level is one of the biggest considerations. And in general, you're typically looking for the option that can give you the biggest reward for the smallest level of risk. If you take on no risk, then you'll likely see a very low return, if any. But if you take on too much risk, then you have the potential of losing your money. Now, I want to take a second to talk a little bit more deeply about how funds can have varying degrees of risk based on what's inside of them. Now, in general, funds and ETFs specifically, and even more specifically, passive ETFs, are a great investment option because they're diversified by definition. Now, like we said earlier, we would typically consider funds, and again, more specifically, all equity funds, which I'll talk more about in just a second, as a moderate risk investment option. But if we narrow in even more on passive ETFs, there's still varying degrees of risk that passive ETFs can take on, depending on what exactly is inside of them. For example, a passive ETF that tracks only US tech stocks is more risky than a passive ETF that tracks the S&P 500, because it includes multiple different industries and not just technology companies. Then to build from there, a passive ETF that tracks the entire US market is less risky than a passive ETF that tracks the S&P 500. And a passive ETF that tracks the entire world is less risky than a passive ETF that tracks just the US market, because again, it would include multiple countries instead of just the US. Now, on top of those examples, the main way that different passive ETFs differ in terms of risk level is by the asset classes being held inside of the ETF. So think stocks versus bonds, for example. ETFs with 100% stocks inside of them are riskier than ETFs with 100% bonds inside of them. And you can have any mix of stocks versus bonds inside of ETFs. The higher the percentage of stocks inside of the ETF, the riskier the ETF is. And the more potential, keyword being potential, you have for your investments to have a higher return over reward over the long term. So to sum all of this up, you could invest in diversified passive ETFs, and within that category, you could have a more risky investment portfolio by investing in diversified passive ETFs that have a higher percentage of stocks inside of them. Or a less risky investment portfolio by investing in passive diversified ETFs that include more bonds or fixed income in general inside of them.
Okay, so now we understand what investment options have what level of risk associated with them. But we're still left with our original question. How do you figure out what risk level is right for you specifically? Well, that takes us back to the concept of risk tolerance versus risk capacity. Like we mentioned earlier, risk tolerance is the amount of risk that an investor is willing to take on, given the ups and downs that could occur with a specific investment option. It's basically how comfortable and confident someone is with investing, and specifically holding onto their investments over the long term, even when they're faced with temporary drops in the value of their investments. Now, the key word there is temporary. And let me explain why. When you look at the performance of the stock market over a short period of time, there's a lot of ups and downs. And let's use the total US stock market as an example here. You can see that over the past year, there's a lot of ups and downs depending on the month. Then, even over a 5-year period, there's still ups and downs, but you can start to see this upward trend. If we look at the entire chart, since this specific ETF, VT, was created in 2001, despite the ups and downs in the market, over the long term, 24 years to be specific, the overall total US stock market has trended upwards. And this is true with other parts of the stock market as well, not just the US stock market. In general, if you're a passive investor specifically, over the long term, the market has historically always trended upwards and had a positive return. So you can see how when we talk about risk tolerance, it's important that an investor is comfortable and confident with holding on to their investments for the long term, even when they're faced with temporary drops in the value of their investments. There's actually a concept in investing known as panic selling, and that's when an investor isn't comfortable holding on to their investments during these temporary periods where the market is down. Sometimes these temporary drops are pretty dramatic, and they can even last for a several-year stretch of time. On a typical monthly basis, the market tends to go up and down only very slightly. But during these specific time periods, when something is going on in the economy, like during the pandemic, the drops in the market could be larger and or last for years instead of weeks or months. When this happens, investors can get scared and feel like they're losing money, even though that's not how it works. You don't actually lose or gain any money in the stock market until you sell your investments, either for a profit or for a loss. So when your investments are down, meaning that your return is currently negative and your money has gone down in value, you haven't actually lost any money at all. And if you're a passive long-term investor like we talked about earlier, then you can see how your return would eventually go back up and trend upwards over time.
Okay, so that's the high-level explanation of exactly why you shouldn't panic sell. But the problem is that some investors don't know that information, and then they do get emotional or stressed out over a temporary dip in the stock market, and then they panic sell, and they actually do lose money on their investments. So when an investor has a low risk tolerance, it means that they're more likely to panic sell during these times when the market is down. In order to avoid that, the traditional investing industry will have those investors invest in less volatile investment options. So ones that are less risky. And why did they do that? So that the investor that has a low risk tolerance won't even have to see these big short-term drops in the market. It's basically saying, let's solve the problem by just ignoring the problem. Again, the traditional investing industry would have this investor with a low risk tolerance invest in lower risk options regardless of what the risk capacity is. Remember that risk capacity is all about your actual ability to take on risk. And your ability to take on risk is mostly based on your age and how long you have until retirement. Now, the reason for this is because it relates to your investing time horizon. Now, we've been talking about how historically the stock market tends to trend upwards over the long term specifically, right? Well, as you get older and closer to retirement and needing to actually withdraw from your investments to fund your day-to-day living expenses once you no longer have a job, the less time you have for your investments to potentially recover from short-term dips in the market. So if you're only a few years away from retirement, you don't have as many years for the market to trend upwards again. But on the other hand, if you're 20 to 30 years away from retirement, then you have time for the market to drop down and go back up again multiple times. So the simple answer here is that when you're young and further away from retirement, you have the capacity to take on more risk. You have the ability to invest in more risky funds during this time. Again, if you have many years to invest and you have a steady income, then you have the ability to take on more risk. And the ability to take on more risk means that you can have a higher percentage of stocks inside of your investment portfolio. So if you're 30 years old, but you currently have a low risk tolerance, imagine if that held you back from ever investing based on your true risk capacity, which is much higher than that. To us, that would be so unfortunate because realistically, risk tolerance is really just based on your education level when it comes to investing. So if we stuck to investing based on risk tolerance, that means that someone with more investing education and knowledge could literally have millions of dollars more than someone who has the exact same investing risk capacity as them, but just less investing knowledge and education, right? Instead, we really want to help fill that education gap for people. Your confidence level and comfortability with investing go hand in hand with your knowledge level. And as long as you're growing your investing knowledge and you have an understanding and an idea of why you're invested in the investment options that you are, and hopefully this video was helpful with that too, then you should be able to take on an appropriate amount of risk for your age. So if we go back to that example of being 30 years old, your risk capacity is pretty great at that time and you likely have a long-term time horizon. So if your risk tolerance isn't there yet and it isn't aligned or matched up with your risk capacity, then work on getting those two things to match up. Education and knowledge is truly the answer to risk.
The moral of the story is that your risk level when we're talking about long-term investing should ideally be based on your age and your time horizon. So your ability to take on risk, not your willingness to take on risk. And you should continue to grow your investing knowledge and confidence over time. Anyways, we hope that this was a helpful overview for you guys, but remember that we go even deeper in simple investing for Canadians. So make sure you check it out either on the link on screen or down in the description box below. And with that, we'll be back next week with another video.